In this video, we'll be looking at the Acme United Corporation's common sense interpretations. Previously, we were looking at the numbers of Acme United Corporations. In this video, we will be seeing the common sense statement and its interpretations of the Acme United Corporations. For the 5 years, it has been prepared and will be compared. If you look at the 2013 revenues, as we all know, the revenue is taken as a base item. Revenue is 100%. So out of the 100%, out of the revenue, cost of revenue is 64.5%, and selling and general administrative expenses is 35.5%, and we add back the depreciation and amortization, that is 1% in the year 2013. Then interest expenses is, of course, it shows the negative minus 0.6%. If you look at the general selling, general and administrative expenses in the year 2017, it was 30.7%, but in the year 2013 it is 35.5%. Next year 28.78%. In the year 2015 it was 29.3%. So there is a volatility in the selling and distribution expenses from the year 2013 to from the year 2017. It shows decrease in trend, that is the company managed to reduce the selling, general and administrative expenses. Like that, we want to analyze each and every line item in the common sense statement. The interpretations. Selling and general and administrative expenses, it is operating expenses overhead. Since SGA is relatively fixed cost, the company would benefit with a higher profit as the business scale. Typically, unless the company expands astronomically, we should see gradual decreases in SNGA as a percentage of revenue as revenue grows, because the revenue is getting increased. For example, let's say the revenue is 100%, $100, and SGA office overhead is 30. That's 30% SGA of revenue. The next year you raise the prices of your product, so revenue goes up 110. Office overhead has not changed because it is a fixed cost, so it remains 30%, 30 rupees. Then the SGA as a percentage of revenue will have go down. In 2014, revenue spiked up, so SGA did go down from 35.5% to 28.7%. Since revenue increased every year since then, we would expect SGA of percentage of revenue to decrease as well, but instead it crept up. So we need to investigate the SGA further. EBITDA. EBITDA margin is arguably the most important margin. It's a more accurate reflections of cash flow than net profit margin, since the net profit margin includes non-cash items such as depreciation and amortizations and the non-recurring income and expenses. EBITDA also captures the business's overhead and utilization more than other margins. Here we see the EBITDA margin spike up in 2014. So because as we saw, 2014 saw a huge jump in revenue. Looking at 2014 to 17, EBITDA margin has been somewhat stable. So from here to here, 14 to 17, somewhat stable, between the average of 8.5% and all. If you look at the depreciation and amortization, this point, for the first 4 years, for the first year, it was 1.1 percentage, and from the 2014 till the 2016, it's almost stable, 1.9, 1.9, 1.9 percentage. Of course, 2017 also slightly increased, 2.2 percentage. So it's most likely a straight line calculation, since it's been about same percentage over the last few years. That might be a straight line method might have the company follow. We see the DA went up in relation to a revenue increase in 2017 because of the revenue increases in a fixed assets this year. We also want to investigate further into whether the Acme is investing in fixed assets or not. That we have to be looking in it. Thank you.